All right, so let's go ahead and look at threats to independence. So a CPA has to be very independent. And the AICPA talks about situations where our independence could be threatened. And so they say here many different relationships or circumstances can create threats to compliance with the independence rule. Many threats fall into one or more following broad categories: adverse interest, advocacy, familiarity, management participation, self interest, self review, and undue influence. Okay, so, in my view, when a CPA, as we talked about in part one, gets put between a rock and a hard place, where some client or some employer wants the CPA to go ahead and, say, for instance, put together some false entries into a report or what have you. What I can see as the biggest threat to independence is just three of these items I think are the biggest ones. I think it's familiarity, self-interest, and undue influence. Okay, so let's kind of take a closer look at where, for instance, familiarity may be a impediment to your independence. So part of it is when you get when you look at some of these fraud cases that have come up, there's maybe one person instigating fraud. What you typically see is the coworkers around that person who has committed fraud. They are totally shocked that that person has done it. They're like, "Oh, I would have never dreamed in a million years that this person was ripping off the company. I mean, I felt like I knew them. We worked side by side for many many years. How I'm just totally shocked that this person could do such a thing." And part of it is when we get to know people and we get real comfortable with them. I understand why people would want to kind of relax around them. You feel like you can trust them or what have you, that you feel like you've gotten to know them. But one thing that's different about being a CPA, that's different than other professions, is that we are charged with maintaining what's called professional skepticism. And that's kind of hand in hand with the other axiom, which is trust yet verify. Okay, so let me give you a little example of this. About a year ago, I was teaching ethics to a large group of internal auditors. Okay, and there was probably about 80 of them in this classroom. And I know that. Let me say also from the outset, some of my best friends are internal auditors. So I love internal auditors. They have a very I guess they kind of see things in sort of black and white, okay, and good for them. They something's either right or something's wrong, okay, and in some cases, while we may say from the outside looking in, good golly, those people are a little inflexible with calling something an exception or not an exception. They're really just trying to uphold the rules, so they kind of see things a little bit differently than even a lot of other CPAs. So as I was teaching this about ready to start this ethics seminar, a lot of times, as you know, in live classes, we've got to make sure everyone signs the sign-in sheet so that we have good records for the board and whatnot. And when in a large classroom like that, when it was kind of spread out, oftentimes at the beginning of my normal 4-hour ethics seminar, I'll say, okay, who's got the sign-in sheet? Please go ahead and pass it around, because generally by the end of the 4 hours, then ultimately it's made its way around and I've got everyone's signature. And so it was actually quite funny because I did exactly that. I said, who's got the sign-in sheet? And this one guy waves. And I say, can you go ahead and start passing it around? And okay, remember, this is a whole group of internal auditors. So the fellow who had the sheet said, no, I'm not going to pass this sheet around until the last 30 minutes because I want to make sure no one is going to leave early. And so I was kind of like a little aghast, only because in my tax trade group that I'm a member of and work closely with, we all know each other really well in this tax trade group, and so we just trust each other. We're like, oh yeah, just pass that sheet around. No one's gonna. We just trust each other not to leave early. But the deal that was kind of funny was the reaction from the fellow audience members, because I would have thought maybe they would have been also taken a little aback as well. But instead, they were all nodding approvingly, because after all, they're all internal auditors, and they thought that that was a very good idea. That indeed the person with the sign-in sheet was just employing good internal controls, and they weren't offended because they weren't going to leave early anyway. So sure, go ahead and pass that sheet around the last 30 minutes, because they were certainly going to be there to be able to sign it appropriately. So no one was mad. And so one thing that kind of taught me was this gentleman, even though he probably knew most of the people in the room quite well, he was going ahead and employing his professional skepticism, and he wanted to make sure that people, that if he was going to make sure that people adhered to the letter of the law. He wasn't going to take people's word for it, and he was just going to make sure that what was supposed to happen was going to happen. And the other thing too is that whole axiom of trust yet verify, and that's something that internal auditors are particularly good at. That they want to make sure that if someone tells them something, they're not going to quite believe it until they verify it for themselves. And the deal is, and we've seen in other fraud cases, like for instance WorldCom, the accountants in the case of WorldCom just went ahead and went along with what the CFO told them. He said it was an error and it was going to reverse itself. And they did not bother to go ahead and check out to see what the CFO was saying was true. They just went ahead and went along with it. And unfortunately, it started a whole a number of events that led to the demise of WorldCom. They started going down that path, and it became a complete and utter disaster. So the deal is that most quote unquote normal people who are not CPAs, they don't understand the whole issue of skepticism and why we have to employ it. And normal people would in fact probably be a little offended, perhaps, if we showed skepticism to whatever whatever they said to us. And so that's why sometimes it's hard for CPAs to show the skepticism, because it has a tendency to maybe offend a few people. Okay, and so unfortunately, we are bound to go ahead and employ this. This is part of who we are. This is part of our jobs and our profession, is to show skepticism. And of course, there's probably better ways of showing it than others, but irrespective of that, we need to be willing to go ahead and verify things before we accept them as gospel truth. Then the next one, I think, as I said, is self-interest. I think self-interest is also a situation where CPAs get themselves in trouble, and that's where that could also compromise your independence. So and the issue with self-interest is that if a CPA, when they're approached to commit fraud, okay, and typically, as I mentioned earlier, it's a situation where, the firm has, the financial statements are not what management likes. They're upset about it, and they want to at least on the surface of things change the financial statements so that they look like they've met expectations. And so typically, again, the situation where CPAs most often commit fraud is they are being put under pressure. They're approached suddenly, and they have to make, in some cases, a split-second decision whether or not they're going to go along with the boss or not. Okay, a lot of times they don't have any time to think about it. And so if a CPA hasn't thought in advance at some point how they're going to respond to situations like that, and they haven't planned for an ethical challenge, they may find themselves feeling like they've got their back to the wall, and unfortunately, in some cases, they respond out of fear, and oftentimes fear deals with the immediate question of how is this going to affect me? Okay, and I get that. I do understand that. And oftentimes it's going to, again, put the CPA between a rock and a hard place. And either choice, it's probably not going to be a good thing one way or the other for the CPA, at least in some cases in the short run, or maybe if you do commit fraud in the long run. So the CPA is kind of potentially really just in a hard place at this point. So one thing that you can do to protect your ethics and make your ethical outcome, a foregone conclusion, which is what we hope for all CPAs, is that you think about your ethics well in advance, and you think about how if you are approached to do a number of things, how would you respond to that? And part of it also is making sure that you've prepared for an ethical challenge, especially in a situation where you may have to walk away from your job rather than commit fraud. Okay, and I've talked to a number of CPAs that unfortunately that was their case. They had to go ahead and quit because they didn't want to get involved in this nefarious plan by the powers that be. And so, what are ways that we can protect ourselves? Go ahead and establish and remove self-interest as an impediment to independence. Well, one thing, and I suspect that many CPAs are good at budgeting, and you probably have already established a good nest egg in case you have to walk away from your jobs. And one thing I do for the graduate students is I have them go ahead and put together a budget of how much it would cost for them to pay just their basic bills for a particular month. And then I make them multiply that amount by 6 months. Okay, so that in other words, there's this fairly sizable nest egg that they need to have at a minimum in case they walk away from their job and they need some more time to find a new one. So I figure 6 months is a good number for them. And then on top of it, once they've established this nest egg that they have to have, I have them figure out what their monthly cash flow is based on their current budgets. And so whatever that cash flow on a monthly basis, I have them divide it into their nest egg to find out how long it would take them to save up enough money for that nest egg. And so in some cases, some of the students are incredibly frugal. Some of them are close to their families. They live at home. They don't spend much anyway. And I've had situations where the student was so frugal that I think it was, in one case, it was only going to take that person like 3 months or 4 months to get a 6-month nest egg together because he just didn't spend much. Okay, and in some cases, the student's budget is so extensive and their cash flow is so low that it's going to take them 13 years to establish that 6-month nest egg. And I say to that student, well, don't you think you're going to be challenged earlier than 13 years when it takes for you to get your nest egg together? And they're like, oh yeah, I probably will be challenged much earlier than 13 years. So I better change my budget and I better rethink how I'm spending my money so I can get this nest egg together a lot more quickly. And so a lot of times that opens their eyes of, hey, you've got to think in advance, and thinking in advance may mean that you have to start now, because it could take you a good number of years to get that money together, and you have to go ahead and plan in advance for your ethics from that standpoint. The other thing I tell the students is make sure that you have a good solid network, and sometimes that's hard because CPAs have very rigorous work schedules, and on top of it, in general, CPAs have a tendency to be somewhat as a profession on the introverted side, and so it may be a little bit harder to get yourself to go out for a variety of reasons to go network with others. But I can tell you, that network is going to help you a lot, especially if you belong to, say, one of the trade groups. Like if you're a tax person, there's Tax Executives Institute, or FEI, Financial Executives Institute, or for internal auditors, there's IIA, and so on and so forth. There's many good trade groups out there that deal with your particular subspecialty. And really, it's kind of a small world. And if you have a really good reputation, it just seems that everybody in a particular city knows each other. I live in a large metroplex, but it is really interesting. It seems like everybody knows everybody, and even in situations where someone calls me and says, hey, this person who used to work for one of your old companies has just applied for a job here, what do you know about him? And if I don't know anything personally about him, I know one or two people I could call who could give me that information. And so, the world of accountancy is smaller than we realize. And, when you get out there and you build into the organization's life and those around you, they're going to build into your life too. And when trouble comes, they are going to help you. I can tell you from personal experience that the one and only time I got laid off at the end of the recession, because my company was in a lot of trouble, and they were running tons of NOLs, and they laid off quite a few people, myself included. I just made a few phone calls, and before you know it, my friends rallied, and they got me lots of interviews. Even while we were still dealing with the recession, there weren't a lot of jobs out there, but they got me at every interview available in the Dallas-Fort Worth area. And in fact, I found out about this teaching position through a contact, and before I knew it, had another job online, and was very fortunate, especially in light of how difficult the job market was at the time. So, get your budget together, get your war chest together, get that network, and so that you can be assured that if something happens, you've got friends who will help you and get you these interviews that you need. And then finally, come up with maybe even a plan C. Is there something else you can do in the event that you can't go back to accounting for some period of time? Do you have another talent? Do you have another maybe side business, or does your family have a particular situation that could help you stay afloat while you figure out what is the next thing for you to do? So, you need to go ahead and anticipate these situations and neutralize these particular threats. The last one, I think, is undue influence. And I think actually this is the most powerful of all the situations where your independence can be compromised. I think, in my view, people are far more influenced by situations around them than they realize. It's very subtle and it's very insidious. But for those of you, for instance, who have high moral character and you are working in a morally reprehensible environment, they are far more likely to pull you down than you pull them up. I hate to say that, but that's typically been the truth, because you don't realize how the attitudes and actions of people around you can adversely affect your way of thinking. And the converse, of course, is true. So the other day I was at the dentist's office, and I was reading one of those high quality publications like People magazine that was lying around over there. And one of the questions, it wasn't exactly People, it was one of those other magazines, but one of the questions was, what's one thing you can do to lose 10 pounds relatively easily? And me always looking after my health, of course, eagerly read that particular article. And the article said, if you want to lose 10 pounds, you should eat lunch with people who are skinnier than you are. And so it goes on to say that skinny people, of course, are skinny for a reason. It's no accident. They eat healthier things like kale and grilled fish and all sorts of other stuff like that. And when you eat lunch with them, you're sort of influenced to eat what they're eating, whether you know it or not. And on the converse is true. And I'm sorry to put myself in this category, but I was raised in Oklahoma, and by golly, we love chicken fried steak in that state. And that's something that I enjoy. And unfortunately, it's not very good for you. So I'd be the type of person who would be the antithesis of that, and probably lead people astray, because and you get that if you're having lunch and everyone's ordering a big barbecue sandwich with French fries, you're like, ooh, that sounds good. And you may end up finding yourself influenced to go that direction. And likewise, the Wall Street Journal a few months ago published an article that said, if you want to improve your work, how people refer to you, or you want to improve how you do at work in terms of your efficiency and what you get done, they said the one thing you can do that would almost immediately improve your efficiency and work performance is to office next to the person who is the star. Okay, so that one person who's the star of the office, who seems to get 100 things done, who's incredibly efficient, probably gets much more done than the average normal person. They said if you office next to them, you inadvertently pick up on their particular habits, and they've done many studies on that, and the people who move their offices next to the star end up doing much better. Maybe it's, you see how the star gets things done, it's more efficient, maybe they have a particular energy when they go to work every day and you're inspired by that, or maybe they have a particular work ethic, and that, whether you know that or not, that rubs off on you. So I think as it pertains to CPAs, the problem is they don't realize when they've inadvertently become under the influence of others. Okay, they don't realize that is something that's creeping into their way of thinking. There was a study done, and they interviewed two groups of CPAs, and this was done a number of years ago. And the what they did with the first group of CPAs is they gave them a hypothetical client, and this client apparently was a good client year one, good client year two, good client year three, always meeting the rules, very above board, did a good job, okay? And then in year four, this hypothetical client has a big change in management, and they're completely morally reprehensible, and they're breaking all sorts of rules, and they're really kind of toxic. And so the question for the first group of CPAs is, how many of you would fire this particular client? And obviously a large number of that group of CPAs under this study said, of course we would fire this client. It's not worth the fees. They're just too toxic, and there's too much exposure with keeping this client. Okay. Now, very interestingly, they went ahead and interviewed a second group of CPAs, and in this second group, they said, okay, how many of you, in the year one, client's good. In year two, client pushes the edge of the envelope a little. In year three, the client pushes the edge of the envelope really hard. And in year four, they fall off the cliff. They are doing all sorts of bad things. They're cheating and not following the rules. And they're in the same pit that the first client was in. And so they asked the CPAs in this second group, how many of you would fire that particular client? And unfortunately, the number was significantly less. Now, granted, this was an involved hypothetical that they gave them, so it's not quite as simple as I'm saying here to you today, but there was a lot involved with this hypothetical, and so it gave the CPAs time to marinate in the situation. And so what the researchers determined is that if a CPA deals with a good client and then that client gets a little more aggressive in the next year, the CPA sort of gets used to sort of the way the client stinks a little, right? And then the next year, when the client pushes them a little bit further, the CPA is really kind of going off the first level of stink, and they don't realize when they've kind of gone to the second level of stink, which is far greater. And then once the client falls into the pit, the CPA maybe sometimes gets carried along with them, doesn't realize that they're in true danger because they have gotten used to how bad the client is starting to smell, okay? Whereas in the first situation, it was very apparent. It was black and it was white, and so the CPA could not ignore the implications of that. So a lot of times you have to be very careful when you are under influence. You don't realize that you have kind of gotten there because of the environment you're there. Okay, so the what goes hand in hand with independence is conflicts of interest, and the AICPA code here says, in essence, that if there's a conflict of interest, in other words, your interest is contrary to the interest of the clients, or it conflicts with the interest of fair financial reporting, then you may need to go ahead and disclose this, okay, to the relevant parties, especially if it's going to be something that would make a difference in the types of decisions that they make. And you should disclose the conflict of interest and obtain consent if it's at all possible until the member concludes that the threats are an acceptable level. So it's something you have to monitor on an ongoing basis, the conflicts of interest, as well as deal with actual conflicts that arise.